Good morning, SMF Street Traders, and good morning to all of our foreign partners and traders around the world. You all qualify to be on SMF Street. Doesn't matter what country you live in, doesn't matter what you think, we know that you qualify to be here, the way that we run our company. And the thing about it is, we care about everyone around the world, and everyone gets an equal opportunity to make money in these markets. What I'm going to show is a quick shot of that S&P 500. We talked about it in several areas of when to get short on contracts and things like that. And part of what we're going to be looking at is the 1175 call, which is up and out of the money on the S&P, closed at 1148. And we talked about, and we're also going to be watching the 1175 call. And let's make sure in the other daily chart that I have the 1175 put in there, so that you have both strike prices. So there is the 1175 put, which is deep in the money, 25 handles. This is the history, the weekly history of the contracts per se. That 1175 call, which is right here, that's up and out of the money. And basically what we're looking for is where the top of the market would take these contracts. But let me remind all the SMF Street traders one thing. Buying back over here for volatility when the contracts were as low as $1, well, heck, these were as low as $1. So having that up and out of the money volatility trade in case they wanted, and September is a very unusual month. You haven't seen a September move like this for 60 years. That was that big August selling that drove these contracts from their all-time highs when we were short the month of August, and it's right there on the website. They took all the premium from up here. Look at what they did. They took the premium out of 1175. The high was 1690, and they took it down here where the SMF Street Trader would love to have that for $1. Because the upside volatility at this time, the calls were deflated. They were inflated up here. They came down. This is the time to buy them when they're inflated, not when they're deflated down here, not when they're inflated here. Sorry about that. So basically, when we take a look at the 1175 deep in the money put, we can see the amount of premium that was taken off of here. The high here was $51 in the contract. 34.20 is the low. Now, the reason why we're going to monitor in the money put and out of the money call both, because we know that the S&P closes the other day at exactly 1148 right here. And we're going to go to the weekly chart. The reason why we're going to look at these two contracts first is because if more premium is taken out, there's going to be more premium taken out of the money call or in the money put. They're going to take more premium, more dollars away from the cost. It's going to go lower if we continue to break through 1150 on the S&P. So let's go back to the weekly chart on the S&P. The S&P 500 is going to come up here, like we said on mini analysis, that the breakout on the S&P happened right here. Anything above 1080 was a buy. Okay, we didn't break the lower end of that 1040 when we were updating people live at that time. But when did the buy really come in? A safe buy was above half of that bar, above half of this bar. That means that these two bars right here, these two down bars, this up bar, half of that bar blew right through there. That's when you wanted to buy up and out of the money calls back then, because that was the August 3-week reversal to these bottoms. That's when the buy happened. That's when we told our big traders and people up and out of the money is the way to be, because it was very, very cheap at $1 to be up and out of the money. Now, let's not forget that that current 1175 contract had hit a peak high of $8, okay? And basically from $1 to $8 is a 70-cent move. You had, let's say you had 20 contracts for $2,000. Well, you'd be up about, well, what can I say? Quite a bit on 20 contracts. You're making $7 a contract. That's 7,000 times 2 is $14,000 profit. Now, what's going to happen with the S&P is this, as follows, as we've said all week. You got to close above half of that bar. And basically, just like you went down over here from that reversal high that we called, you can leverage right back up there to the trend line. It's possible. That would be called a total what? V shape. See the V? But let's not look at it that way. Let's look at it the SMF way. The right way. The pricing mechanisms that we have and what we use and what we do. We are always right because we understand where the price is. We're always right about price because we're willing to accept what the price of the market is. And basically, like I said, when we took out these tops right here, these two double top reversals down to that bottom, we shot right through it. That makes it bullish. This is the stronger bull rally for September, and this kind of rally has not happened in 6 decades. Hey, phenomenal things can happen within the tape, but remember, you're re-leveraging off the bottom of this complete downtrend over here. You still have a long ways to go to the upside, but you're going to have to clear half of that bar. Now, if we were to hold there at resistance and not break through it, well, then we would be moving over here to our other contracts, SMF Street, and let me show you what I'm talking about. Here are the strike prices right here. We would be looking at the, we already had bought the 1130 call up and out of the money back when the S&P was down toward 1100. We showed where all the big interest was being moved at the time in the contracts. We also know that when we look over here, that we're going to show you something that within this October contract, 165,000 contracts, everyone's betting for a big down month in October because they are. It's right there. And even below the marketplace, you got 70,000 contracts. This is when these guys were barreling in this put side of the contract. That's when the weekly chart had a buy and was time to go long up and out of the market. They were fighting and buying through the breakout short. Well, that doesn't mean just because people have money that they're smart in how they use it and on what side of the trade at the time that they're using that. And basically, you can see here the amount of short interest is another good reason to walk that S&P higher because all of that money is below the water. And SMF has been pointing this out to our senior traders, our worldwide traders, our foreign traders, our MMTs that we have. Our whole base has been being taught about how to price this in. And the breakout happened there, and it kept going. And it took out that top right here, this double top. It took it out, which just so happens to be half of the SMF bar. That was your upward resistance. We took that out on 912, and we've gone up here to that half bar. Now, in the next tape, I'm going to be putting together the S&P 500 put and call, wholesale, retail, where to price the market, why you shouldn't fight the market, why buying volatility over here works for $1, just in case you get one of these big moves in September. No one ever thought that would happen. Hey, it's a one-time event. It hasn't happened for 60 years. It doesn't matter. Your downside was $1. That's all that mattered. You weren't buying them up here at 15. You're buying them down here at $1. And that gives you the right to be on the other side of all of this heavy put buying that we had showing people. Because we did. And we recorded them live on the stockmarketfunding.com website. Go look it up. The thing about it is, having that up and out of the money volatility made you money that you thought you wouldn't get. For $1, you thought you weren't going to really make anything off of that way because of the way that Septembers are. But as we were telling, the big part of our base was to buy that volatility for cheap. You were inflated. You're deflated. Deflated equals buying. Dollar cost risk management up and out of the money. risk management skills for these kinds of moves. And let's not kid each other. The thing that we're going to be looking at next, we already blew through there. That's bullish. We've got a weekly buy signal here. Bullish. When you went into this MACD reading, when it went into the sell signal, first it topped up here where we were shorting it. As each one of these weekly bars went down, you went down here with the trend. When those go down, trends go down. But now that we're back into, that's the sell signal here at the bottom, and this is how you put in that weekly bottom here on this MACD. I'm not here to tell you about it in this video. The MMTs know exactly what I'm talking about. And we ascended mathematically in that direction, and that's what provided that S&P 500 breakout because of that mathematical move up. And I've got a weekly buy signal, and that's given that momentum. Nonetheless, everything has a saturation point. And basically, if we break above it, we're going to look at where to buy the 1175 call. That's the monthly chart. We're going to look at where to take advantage of these strike prices and where the put side is versus the call side. We're going to measure that volatility. Volatility, risk management volatility, when you're trading indexes and you buy 50 contracts at $1 and you make a $7 move, that's $35,000 on a $5,000 investment. Yeah, you could have lost the $5,000, but don't forget, at the time back then when the market wasn't acting well, back over here on this chart right here, on this weekly chart, on this move, back when we were down at the bottom, everyone was getting in the put side of the market. What they didn't understand was the SMF market maker trader buy bull bar up above and taking out these last two weekly lows is what constituted that buy. Yeah, so what? It ran 40 points, but it confirmed it, and it's been going ever since. Now, what we're going to be looking at here is how we get on the call and the put side again, meaning that we're still got this call contract right here. Let's not get out of reality. We got the live video and the live trade. So let's not get out of the reality that we were buying this over here. It's at $30. But we were buying up and out of the money when you were totally deflated here on this contract, this 1130 call. At the time, we were on the weekly chart down in here. We hadn't even broke above half of that bar. As soon as we took out half of that bar, up above half of that last down bar, the SMF bar, that's when we were telling people in the live videos and the live training last week, you got to own the 1130 call up and out of the money, and you were rewarded. So when you are trading both sides of the market, call and puts, you always, if you're short and it was working for us, remember that they took this 1130 call all the way from $36 down to just call it $6. They took $31 of premium that made that wholesale so that you could buy that up and out of the money if there was any volatility to the upside. You could cover your short and still have a profit and not be whacked by the unorthodox move, or I don't know if that's the right word, but that big rally in September that no one would count on. And the only way that we would count on it would be by using our weekly chart and our SMF Street skills. So once again, folks, it's all about how to master buying cheap for the upside volatility in case they run it. And if you're short, you come out of the short and you let that thing run and you make a lot of money. And we're going to talk about these put and calls in the next chart. And basically, we're going to be zooming in, like I said. We're going to be watching the balance ratios. And I'll do that on the next video. Let me put the 175, that's the 175 put in the money. Let's put the 175 call back here in the money and do that one on the next video. And I will give the SMF MMTs the pricing entries and exits after the video is over. But this is the next one we're going to cover.